If you own multifamily properties here in Los Angeles or San Bernardino counties, this video is for you. I just went through all the analytics. Where is the market third quarter 2024 in terms of sales volume, price per unit, cap rate? We have all the details. Stay tuned. Hi, this is Kris German, and welcome back to the Apartment Dealer Show. Today, we're going to dive into the analytics. We're going to nerd out here a little bit on the numbers, but where is the market third quarter 2024? And specifically, as we compare year over year with 2023, are we moving in a positive direction? Are we moving in a negative direction? What is it that's currently taking place? This information is going to help you as you contemplate a potential purchase, a potential sale, or you just want to stay in the know with respect to the value, the rental rates in your area. That's what we're discussing here on today's show. Now, let me start by speaking in broad terms. Let me paint in broad terms here. Some generals with respect to the multifamily market as we stand here today. First, I would say the sentiment, investor sentiment overall is improving when compared to, say, the last couple of years here. And rightfully so. Landlords have been through a couple of challenges here when it comes to interest rates and the economy and rising costs and what have you. So not that much of that has changed. I think investors just now have become accustomed to the new norm. And yes, interest rates have come down somewhat. And so that's helped things. But overall, the general sentiment, right? So we went from a market where interest rates were very low, property values were flying high, and almost in an instant, everything changed overnight. And it's taken some time for investors to maybe come to a realization that the cycle has changed and, get their bearings and then, be able to refocus and say, okay, given the new norm, my financial goals don't change. So now I chart a new course with the information at hand, and now they've began to do so. So overall, we are seeing more deal flow, more increased volume of sales. But just in general, the overall sentiment, and speaking with landlords, again, as a multifamily broker here locally, I am on the phone with investors, landlords like you, every day, day in and out, and just the overall sentiment has improved from where we were. Now, if we want to paint in a really broad stroke, cap rates in general, what's gone on over the last year or so, and especially since the beginning of this year, well, they've increased, right? I would say in general, most deals on the market today are at a 5% cap rate or higher. Some areas are seeing a 5.5% cap rate. I've seen deals now sell for 6% cap rates, and that was once upon a time unheard of, right? We were living in a market where cap rates were about 4% for some time, and investors were happy to trade within that market. Now the cap rates have increased from there. So one would think, okay, well, if there was significant deal flow with 4% cap rates, and yes, interest rates were lower, but when you look at the spread between the interest rates and the cap rates, it wasn't like it was a huge number. And here we are today where, yes, there have been deals probably very close to a market of which you own in. If you own in one of the core areas that I service, my team and I service, then there's deals that have traded at 6% cap rates. Deals that I would easily say, you know what, I would buy that deal as an investor. So cap rates are up. Third, interest rates are on their way down. Here recently, the Fed lowered the rate. And much talk of the town is that's going to continue to be the trajectory that we're on. That would be good news. Some say, hey, that's politically motivated. Some say, no, if they see something in the water and there's trouble in the economy. I don't know. I'm not an economist, but the bottom line is here the Fed did recently lower the interest rates. And for you and I, as investors, landlords, the question is, okay, well, does that have a direct impact on the interest rates for commercial loans? The easy answer is no. Commercial loans are tied to primarily the 10-year Treasury, And it's not a given that if the Fed lowers the rate, then the yield on the 10-year Treasury will go down. That we cannot assume that. Yes, interest rates for commercial loans are down. We were at a high at one point of about 7.25. Today, if it's the right product, you're a seasoned investor, you have a good resume, meaning you can show a lender that you have some multifamily ownership under your belt. You're not new to multifamily ownership. You're probably looking at a rate up and around 5.75 to 6% in general, especially if you own within the markets that my team and I service. So interest rates are down. So then, let's say commercial rates, they have come down. Let's say that continues to be the trajectory as well. Well, then when can we anticipate our market prices, market values to increase? It's interesting because CoStar, who those of you that have seen any of my educational content or the analytics we go through, we lean on CoStar heavily because they're an independent third party that does a great job of collecting the analytics, all facets commercial. They did the study for me just as I was thinking, okay, I'm going to have to compile this information and see, what have property values done shortly after there's been a reduction in rates. They had it all there for me. And so what they found is that it typically takes the commercial markets 1.5 to 2 years to then change direction. Right now, we're kind of in a downward trajectory to then change direction in a positive movement in terms of property values. Again, one could say, well, that's their analytics, that's their guess. Fair enough. But they took this out a couple of decades to show, look, this is the trend. For example, in 2007, from that point, as interest rates were coming down, it took 10 quarters, I believe it was 10 quarters, in order for the market to rebound and then values to start heading up. So are we going to see property values increase overnight? I don't think so. And putting interest rates aside, I think in general, talking with investors, the feedback that I get is, look, Kris, multifamily ownership, it's completely different today than it was 20, 30 years ago. And of course, if I'm talking to individuals talking about 20 or 30 years ago, I'm talking to seasoned investors. And they're saying it's changed so much, in fact, that it's taken out a lot of the upside with rent control and the restrictions. So given the fact that my income is going to grow at a slower pace and potentially my property value will grow at a slower pace because it's tied to the cash flow, I need to be purchasing at a higher cap rate. So higher cap rates in and of themselves, if investors continue to demand that they want to pay or purchase a property at a 5.25 cap rate, a 5.5 cap rate, let's say we even get to 6% cap rates, if that becomes more the norm rather than just some spotted sales here and there. Well, because we're restricted on our annual increases, it'll take that much longer for properties to increase in value to offer that type of yield. So just something to keep in mind. Again, good news, interest rates down, but it may take some time before we see some big movement when it comes to property values. Vacancies continue to stay elevated. And this really does boil down to not just what city you own, but sometimes block by block, depending on how dense the community is with multifamily properties around a property that you own in terms of what's going on with the vacancy. In general, there's more vacancies or more apartments available to rent. In general, it's taking a little bit longer to rent those apartment units. Not only do I see that from the data we pull, say like on Zillow, but just again, in those conversations that I'm having with investors, I had a conversation with an investor this morning, and he and I were discussing his asking rental rate, getting my feedback. What did I think? Because it was taking him longer to rent his units. And to his surprise, the rental rate had come down from where it once was, in my opinion, or at least not really my opinion, the data that I used to formulate my opinion. And so he's going to have to adjust his rental rate in order to get these places filled. And so that takes me to my next point in terms of the rental rates. Rental rates are not growing at the pace, of course, that we had through COVID and post-COVID. I think most of you realize that we were not going to see apartment rents jump 10, 15% year over year, continue, again and again and again. That just wasn't going to be a reality, especially when you had the economy pushing against that, especially when, wages have not kept pace with Bidenomics, inflation. So rental rates, again, painting in a broad stroke here, have come back from their highs that we had experienced post-COVID. They're still high, especially, ask your tenants if they're high, right? So asking rents are still high. They're just not growing at the same pace that we were experiencing. And the issue is here, but as a landlord, your costs have increased significantly when it comes to, say, property insurance. For many of you, your premiums have doubled, say even tripled, especially if you don't have updated electrical subpanels. You still have galvanized plumbing. Your roofs are not newer. The insurance companies also, your heaters are, the wall heaters are ancient. The heating system is ancient in your units. Then you're getting hit with these higher premiums because not that many insurance companies, as of right now, the recording of this video, would like to insure that type of property. You take a property that has Zinsco or stab block subpanels, galvanized plumbing, a roof that's 20 years old or older, and wall heaters that look like they're from the 1970s, good luck getting coverage on that particular building. And so our rental rates are not going up as much, but our costs are definitely increasing. Labor costs has increased, the cost of materials. So that's, just been, if you've done any type of rehabs or even just general maintenance, right? You've experienced this, or if you recently got a notice of non-renewal from your insurance carrier, you know exactly what I'm talking about, that now you go to find new insurance, and it is definitely not as cheap as it once was. When we look at renting versus purchasing a home, and this is important for landlords, right? Because single-family homes, whether they be rentals or even if our tenants have the ability to purchase, that's a competitive market, if you will, in order for us to keep our units full. It is still cheaper for tenants to rent than it is own. And, if you have lowering interest rates, which is probably going to fuel the single-family market, for many of those, homes will still be out of reach. But if it's anything like we've experienced before, those of you that own, say, in A-type communities, you have rentals, let's say, like in Pasadena, Sierra Madre, Santa Monica, some of these, we would call them A locations. These are the type of tenants, though, that interest rates come down enough, they definitely are looking at purchasing a home, and then you see an increase in vacancy. So that's just one thing to be mindful of. As of today, still cheaper to rent than buy. These interest rates continue to come down. And, depending on where you own, then your tenants may be looking for a place to purchase themselves, which may not in and of itself be bad news, because especially if they're paying an extremely low rent, hey, you would love to get that unit back and be able to bring it to market value if the laws don't change. And I'm going to get there in a second. But if the laws remain the same, you'd love to take back vacant units or take back units and have them become vacant, especially from your tenants that are paying extremely low rents. So that, can be seen as the silver lining. And on the horizon here, vacancy control. Prop 33, it is on the California ballot. You need to pay attention. You need to get out and vote. You need to tell everyone that you know that's a voting age to vote. No on 33, because that would do one of three things. We've already discussed it on our show here. I would point you to the recent video that I just recorded with Michael Brennan, the eviction attorney, where we dig into this. But vacancy control, that's what we need to be on high alert about. Should Prop 33 pass, it then would give the individual cities the ability to control how much you would ask or be able to obtain for a vacant unit. And what could that look like? It might be one of a couple things. So the state, let's say people get out, there's more tenants than landlords, and say people vote this thing into law. So Prop 33, God forbid we wake up November 6th and it's passed. Okay. It doesn't put vacancy control in law in all the cities. It gives each city the ability to determine, okay, do we want to enact vacancy control, or I guess even the counties for that matter. Now, if you own in a city that already has decided that they have their own individualized rent control, Bell Gardens, Baldwin Park, Pomona, Pasadena, and so forth, then if you're a betting man or woman, I think you can, it's highly likely that those type of cities are going to adopt vacancy control, because they're the few cities that actually have their own individualized rent control to begin with. But it would give all the cities the ability, so no one may be safe, And so let's say it passes. Okay, what does that mean? Vacancy control. Again, a tenant moves out. Normally, in a free society, in a capitalist society, you'd be able to then obtain, go out and see, okay, what's the market rent, right? Supply and demand. Maybe partake in the rental survey that we offer here, or, do your own. But okay, here's the market rent, and that's what you fill the unit at once you've, completed your remodel, updating, or whatever the unit needs. Well, vacancy control passes completely different. Probably one of two scenarios. One, tenant moves out. You're only able to charge the new tenant a percentage above what the old tenant was paying. That's disastrous. Or two, the city would determine, okay, what's the average asking rent for 1 bedrooms, 2 bedrooms, and 3 bedrooms based upon some housing chart, not a rental survey on Zillow, based upon their own choosing. And for example, Bell Gardens has a formula like this, and if you take a look at what they're using as their average rental rates, far below market. Anyways, it would be the city determining, okay, here's the asking rent for a 1 bedroom, 2 bedroom, 3 bedroom. Maybe they'd give you some variance based upon the square footage, something like this, some type of formula. Bottom line is you would not be able to obtain market rent. That would be a disaster. And my prediction is, and I hope I'm wrong, but just like we predicted correctly here on our show, that if interest rates went to 6% and we climbed, and we have the charts on the older videos to show all this, we pinned what was going to happen to cap rates almost right on the dot. And it was based upon math and just that, simple figures. My guess would be vacancy control passes. And for those properties that have extremely low rents, your value of your property will change overnight by 20%. 20%. Easily. And why am I saying 20%? Is because the differential you're going to need in order to increase that cap rate, because from the buyer's perspective, you may not like hearing that. You're a landlord right now. You know your rents are low. You don't like me saying that your value may go down 20%. And I'm not saying that as some type of scare tactic, like, oh, I'm saying sell. I'm not saying any of that. What I'm saying, though, is let's be logical. Would you repurchase your property? And if vacancy control is in place, and now you're buying a building, and the seller has basically etched your destiny in stone based upon the rents that they were charging their tenants, because even if somebody moves out, you're only able to raise it a percentage above what that old tenant was paying, or worse, the city will tell you how much you can rent your unit for. Any mix of that, a buyer's going to say, okay, you know what? Yeah, I'll buy your building, but I need to start at a much higher cash flow, higher cap rate, okay? And you have to bring down the building's price in order to increase the cap rate. I need to start at a higher cap rate because going forward, my growth is going to be incremental from there. And when I go to sell in the future, and if the laws remain, I know that the appreciation factor here is going to be much less than if I were to purchase in a neighboring city that, say, doesn't have vacancy control. So these are things to consider. This is the reality. Multifamily ownership has changed. You must be much more intentional about the direction that you're taking your properties. When you take a look at your game plan and what's going on with the debt on your property, your projected rental increases, where you're going to purchase your next building, a cash out refinance, all these things, we have to be much more intentional. Now, that was a mouthful, but I want to just bring you up to speed where we are third quarter here, 2024. Now we're going to dive into the analytics. So if you own within the corridors that my team and I service, where I and my team represent landlords in the purchase and sale of multifamily properties, this data is going to be meaningful to you. Or if you look to purchase a building in one of the communities that we serve. And what are those communities? Let's break them down. First, we have the East Los Angeles corridor. That consists of Boyle Heights, East LA, and El Sereno. Next, we have what I call the 710-91 corridor, Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Southgate. Third, West San Gabriel Valley, Rosemead, San Gabriel, and Temple City. The East San Gabriel Valley, Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. The 605 corridor, Bellflower, Downey, La Puente, Montebello, Norwalk, Paramount, Pico Rivera, Whittier, Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, Upland, and Inland Empire East, Bloomington, Colton, Fontana, and Rialto. Now, aside of, why has Kris chunked them down this way, the various cities? Because aside of the geographic location, we're choosing those cities that butt up against each other, that have a similar tenant base, similar rental rates, and similar values. Now, of course, it does vary amongst those cities. Okay, I get it. I've sold properties literally, I think, in every city here that we have listed. But it's close enough that we call this a corridor in order to put the analytics together so that it makes sense and we're able to, share it with you in bite-sized chunks. Okay, so East Los Angeles, let's start there. We're talking about East LA 90022, 90023, El Sereno. When we take a look at total number of sales thus far this year, there's been 14 multifamily properties that are in the size of 5 units to 50 units. Okay, that's what we're tracking here is multifamily properties that are between 5 units to 50 units for all the information I'm going to share in the various corridors. Here, there's been 14 sales in 2024. In 2023, there was 11 sales this time of year last year. So there has been a slight uptick in total sales volume. When we take a look at total sales volume in terms of dollars, in 2023, it was $15,400,000. Today, we stand at $20 million thus far this year. Now, when we take a look at price per unit, here today, we're at, on average, $201,000 per unit for those properties that have sold this year. Last year, this time, the average price per unit was $204,000. So not down as much as I would have thought, but still down because, again, cap rates have moved up, property values have moved down in general. Cap rate, we are now sitting at, on average, a 5.18% cap rate. That goes to my opening comments that easily everywhere it's 5% or more in terms of the cap rates. Last year, this time in East LA, we were sitting at a 4.87% cap rate. So that's a decent enough swing, right? It's had an impact on property values. GRM, gross rent multiplier, about the same year over year. Price per square foot actually is more this year. Now that could be, there might be a few sales in there this year where they were newer construction. So price per foot, they sell at a higher dollar amount. When we compare to 2023, because again, typically people are looking price per unit more and that's come down. But nonetheless, price per square foot has gone up from $313 last year to $335 a foot this year. And in this particular corridor, there are 690 buildings that we're tracking to collect this data. Let's take a look at the highest sale and the lowest sale, right? For some comparison here. So third quarter this year, a 6-unit property in Boyle Heights sold for $2.5 million, $416,000. That's a big price tag in Boyle Heights if you know the area. And when you compare it to the lowest sale here, which was a 10-unit, same city, Boyle Heights, sold for $1,220,000, $122,000. So obviously, there's a difference when it comes to the unit mix, right? How many bedrooms per unit, the age, and so forth. It's not that they were 2 replica buildings on the same street and one happened to sell for $416,000 a door and the other $122,000 per unit. But just to give you a flavor of, if you thought, well, gosh, I didn't realize you could pick something up for $122,000 today in Boyle Heights. That's a figure that we haven't seen probably since 2015 or so. Just to let you know, there are deals out there. The rental rates. So now I've compiled our recent rental survey. We're pulling the rental rates from Zillow. We're taking a look at Retometer, CoStar. So you can pause the video, find the city that you're interested in. Is it a studio, 1-bedroom, 2-bedroom, 3-bedroom that you're looking to track in terms of the rental rates? And here is the data. Let's now move to the 710-91 corridor. This year, thus far, there's been 24 sales versus last year this time, there was 21 sales. Sales volume thus far this year, $47,726,000. This time last year, we were sitting at about $40 million. So there's been an uptick in total sales, right, and deal volume. The average price per unit has slipped, as we would assume. Last year, this time, average was about $237,000 per unit. Here today, we're at about $203,000 per unit. And the cap rate has gone up to 5.26% versus this time last year, we actually were at 4.5%. 4%, right? So a very stark difference there. GRM has gone from 14.5 last year to now 11.89. So it's come down as well with values. And our price per square foot has come down from $341 last year to $277 now on average. And for this particular corridor, we're tracking 2,467 buildings, of which we compile this data from. When it comes to the highest sale and the lowest sale here over the last quarter, 12 units in Southgate sold for $3,495,000. That's $291,000 per unit. That's a big number when we're talking about the city of Southgate. And the lowest sale, 14 units in the city of Maywood, sold for $2,142,000 per unit. If you can imagine, again, that's a value that we haven't seen for quite some time. Now, that particular building, was primarily one bedrooms, older building. And again, maybe the marketing of the building had something to do with it, the condition. I wasn't involved in that sale. But what I'm sharing with you is that you can pick up a deal in Maywood, $142,000, make the right moves, and there's some upside there. Rental rates for the 71091 corridor. Find your city, find your bedroom count, and there is your rental rates for today based upon Zillow, Redometer, and CoStar. Now, moving over to the West San Gabriel Valley. Very interesting that we're sitting about the same number of sales as we were last year. Last year, this time, we were at 7 sales. There has been 8 multifamily properties this year that have traded. Last year, though, those 7 sales amounted to $32 million. Our 8 sales this year have only amounted to $25 million. And here you go. We've moved from $319,000 on average per unit for the sales last year to $291,000. So we see that downward movement. And interestingly enough, our cap rate, though, has gone down 4.95% last year to 4.44%. I think this might be the only corridor that we see that type of movement. And the GRM, big move. Last year, we were at 18.4. Now this year, we're at 14.83. A big difference in terms of the gross rent multiplier. And interestingly enough, our price per square foot has gone up from $364 to $402. Now, again, sometimes that might be because of some buildings within, say, the sales of this year, based upon age and what have you, commanded a higher price per square foot, but nonetheless, that's the data. And for these sales, we're tracking 1,926 buildings in this particular corridor. We take a look now at the highest sale in the West San Gabriel Valley. 5 units sold in the city of San Gabriel, $1,720,000. That was $344,000. And the lowest sale this year has been 17 units in the city of Rosemead, $4,150,000. At $244,000 per unit. So for those of you that track this area, the averages. To say that the highest price per unit is only $344,000, whereas before you would have seen things probably closer to $400,000. And taking a look at a deal now trading at $244,000, where again, that was not the norm, as when the market was more elevated. And here are the rental rates for the Western San Gabriel Valley based upon my recent rental survey. So pick your city, pick the bedroom count, and that is the average asking rent for that unit type as of now. Okay, now we move to the East San Gabriel Valley. Interestingly enough, we're sitting at about the same amount of sales. This time last year, we were at 24 sales. This year, thus far, 23 multifamily buildings have sold in this corridor. Sales volume. Interestingly enough, we're sitting at about very close to the same number here. About 66 million in multifamily transactions had taken place this time last year. And here we are today, 67,810,000. So yes, it's up somewhat, but very close. Price per unit. Here last year, on average, buildings were selling at $282,000, almost $283,000 per unit. Now, sales this year, $286,000. So very steady, very steady. Same can be said for cap rate. This time last year, 4.39% was the average cap rate. Today, 4.58%. GRM, 15.12 to 14. Average price per square foot last year, $322. This year, $317. So when you take a look at the overall numbers here, the Eastern San Gabriel Valley is performing very strongly. And I know this area well. When I first started selling multifamily properties back in 2007, This was the first geographic area that I started working as a broker. And it's always proven to be a very good location, not to say that the others aren't that I've covered. But if you look at these numbers, when we're looking compared to the other corridors where there's been, some more swings in terms of values, here in the Eastern San Gabriel Valley, things have been very steady, just something to note as you're contemplating different areas. Now, let's take a look at the highest price sale and the lowest price sale. Here recently, 9 units sold in the city of Covina for $3,450,000. That's $383,000. I know the building, I know the deal. That investor, sorry if they're watching, they overpaid for this property. Now, they may have had a need. Maybe they were up against a timeline deadline for a 1031 exchange. Maybe the price point and what have you fit exactly for some money that they needed to invest, to deploy. I don't know, but that's too big of a number given this market for a 9-unit in Covina, but it is the highest sale. Kudos to the seller. They made out like a bandit on that deal. And then here, 6 units in Covina just sold for $218,000. I know the building. I know the deal. I just sold a property directly across the street from this property for a client of mine. We sold at a much higher price per unit. I won't get into it because I don't want it to seem like I'm disparaging the agent who sold this building. But I'm just saying directly across the street, I just sold a building for a client, much higher price per unit. And I have a client buying a property probably 4 buildings over from this particular property right now. We're in escrow at the recording of this video. I think we're scheduled to close in about a week. And it's higher than that price per unit. Even we did a very good job negotiating on our buyer's behalf, and we felt like we got a very good price. That is a rock bottom price. So what's the moral to the story? Moral to the story is look alive. There are deals to purchase as of right now. And I said interest rates have come down. Remember, 7.25% is where we're at today. If you're the right buyer, the right building, 5.75. Cap rates up, meaning your rate of return is up today. You put all that together with the right purchase, that's a winning formula, even amidst some of the challenges that I mentioned at my opening. For your rental rates in the Eastern San Gabriel Valley, pick your city, pick your bedroom count. These are the averages based upon Zillow, Retometer, and CoStar. These are the average asking rents right now for these different unit types. Okay, now let's jump into the 605 corridor. This time last year, we had seen 32 multifamily properties sell. This year, year to date, we're at 27 transactions. Total sales volume, we are currently at about 97 million. This time last year, we were actually sitting at 127 million, almost 128 million. Big difference there. Price per unit has fallen. Last year, this time, we were at 260,000 on average per unit. Here today, we're at 247,000 per unit. And the cap rate has increased, as we would assume, from 4.13% last year to now 5.32% on average. And the GRM has gone from 15 to 13. And that's a big swing, right? So if you're buying a deal in these particular cities and you're getting over a 5% cap rate, buying something 13 GRM, that would have been seen as a deal all day long just a couple of years ago. So again, right, that's why sentiment has increased. My opening remarks, more deal flow, because investors are saying, okay, now things make sense, right? There's some cash flow to be made here on a monthly basis and so forth. Price per square foot has gone from $351 to $327 down. And for these analytics, we are tracking 3,225 buildings in this particular corridor. Highest sale now in the city of Downey, 24 units sold for $7.4 million, $308,000. Now that is the highest sale, but those of you that know the corridor, know the area, and I'm saying that the highest price is $308 a door, people would say, well, gosh, I remember when that was more around $350, $370-ish there for, some of the higher buildings that were selling. So of course, things have changed. And the lowest price per unit building that's sold is 32 units here in Bellflower, $5.6 million, $175,000 per unit. So I had to take a closer look at this comparable to say, what happened here that it was such a favorable price from a buyer's perspective. And there was notes there that the seller was looking for a quick sale and if somebody could transact fast, the seller was negotiable. So that 5.6 was far from the original asking price. And the buyer got a deal, right? They had the money ready to go. They were actively looking. So what's the moral of the story? There are deals to purchase if you're paying attention. Now, your rental rates for the 605 corridor. Pick your city, pick your bedroom count, and that is the average asking rent as of today based upon Zillow, Rentometer, and CoStar. The Inland Empire West. This time last year, 19 properties have sold. This year, 7. Big difference in the Inland Empire. Last year, this time, $52 million worth of multifamily transactions had taken place. This time, right now, as of the third quarter of this year to date, $22,500,000. Half, right? Our sales have cut in half. The average price per unit, $251,000, has now dropped to $207,000 as of this year. Cap rate has went from on average last year, 5.14% to now 5.98%. GRM on average has dropped from 15 to 11. And the average price per square foot is $362 to $308. And we're tracking 1,123 buildings here. Now, again, if we're looking at Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, Upland. Now, out of that batch, maybe we could take Pomona and throw it outside again, because again, nothing against my Pomona investors, but I got to be brutally honest here. Pomona has their own version of rent control. I would imagine their sales are probably some of those that are on the lower end of the spectrum here in terms of, what's bringing down the averages. But if you, and the other cities here, if you're talking about buying deals at 11 times gross, 12 times gross, over a 5% cap rate, that is something to highly consider. I've owned and managed properties in this locale to be able to tell you, right, that this makes sense. So again, just something to keep in mind. Now, we take a look at the highest sale and the lowest sale. The highest sale, 15 units in the city of Pomona, sells for $4.1 million. That was $273,000 per unit. I actually represented the seller in that particular transaction, and so can share a little bit, why the higher price. Building was turnkey, a lot of capital improvements, and so and the higher end rents because he had done the work and renovated the property, so he fetched a higher price. And that's what happens when you do the work and you've invested money in the properties, you've done what you have to reposition the tenants, right? It equates to higher value. And then the lowest price per unit we've seen here is 44 units in Pomona, $9.9 million, traded for $225,000. In terms of your rental rates, pick your city, find your bedroom count. These are the averages based upon CoStar, Rentometer, and Zillow. And those are your current asking rents. And rounding out the data here, the Inland Empire East. And here in the Inland Empire East, we've seen an uptick in terms of sales and volume and so forth. So this year, so far, we've had 9 total transactions. May not sound like a lot, but it's a lot more than 5. We were sitting at 5 sales this time last year, so we've nearly doubled. Total sales volume has gone from about $4.3 million to $21 million this year. The average price per unit, $201 versus $205. And the cap rate, though, interestingly enough, hasn't had much movement from 4.3 to 4.4. Our GRM has dropped from 15 to 15.65 to 13.75. And interestingly enough, our price per square foot has gone up to $271 from where we were. And we're tracking 287 buildings. Not a ton of stock here when we're looking at these particular cities, 287 buildings. Now, in terms of our highest sale, lowest sale, here recently 20 units traded in the city of Fontana for $4,228,000. That's $211,000 per unit. That's good. Things still above $200,000 a unit in Fontana. And then on the low end of the spectrum, 6 units in Colton sold for $925,000. That was $154,000 per unit. In terms of your current asking rents, these are the averages based upon Rentometer, CoStar, Zillow. Find your city and the bedroom count that you're interested in. That is the current average asking rental rate. Okay, ladies and gentlemen, so what have we learned here today? In general, overall sentiment is up. Things aren't, from a landlord's perspective, investor's perspective, as dreary. We've seen that because the total sales volume in general has gone up. And it's gone up because deals are more attractive. Cap rates have gone up. Deals actually make sense from a cash flow perspective. There's been I guess simply said, there's been a meeting of the minds between buyers and sellers in terms of where to transact. And buyers are saying, okay, now given these prices, I'm ready to move. With that, though, you see many properties are having to be reduced in price over time as they sit on the market for, that seller to find the sweet spot of, okay, what is my property really worth? A broker can tell you, an appraiser can tell you what they think the property is worth, but a buyer, right? The open market will really determine what a property is worth, a building is worth, what an investor is willing to pay at the end of the day if you're looking to sell. And cap rates are up. And so again, we've seen more volume. Second, I would say what we learn here, there are deals to buy in the various corridors, right? There's opportunity. Much higher cap rates. GRM is down. We mentioned interest rates are down. That makes it favorable to buy, favorable financing that's available. So there are deals to buy. If you're looking to expand your portfolio, then you got to, be alert and, have someone searching on your behalf so that they can share with you and underwrite, okay, there might be a deal that comes on the market. And simply looking at the price per unit, one might say, oh, well, that's a deal. It has to be underwritten, right? Okay, let's take a look at the rents. Let's take a look at the expenses. Let's underwrite it. Let's put some financing against it. Let's see how the cash flow holds up, right? So you need someone doing that on your behalf. And if they're worth their salt and you know how to underwrite a building, then they very quickly could be able to tell you what's a deal from what's not a deal. Not, it's all the same to me because I'm going to earn a commission, right? That's what you don't want to hear from a broker. So you need to work with someone who can underwrite a deal. But there are deals to purchase. I can speak for my team and I. We are slammed right now, selling many, many deals. We stay very busy. I'm very blessed in that way, very grateful. And historically, we probably sell, say, 2 times the amount of buildings that the average broker trades in a given year. And again, we're thankful for the business. I don't say that, patting myself on the back. But again, I mention that because we have so much deal flow that we're involved in. We're able to keep our thumb on the pulse in terms of what's going on in the marketplace, what are landlords experiencing, what's happening real time in the movement of values and so forth. And it's a much better place than if you probably go back to my video that I recorded this time last year. I probably had a frown on my face and didn't have much energy because it was tough. Last year was a tough year. And so things are definitely on the upswing. Now, for those of you who own in a corridor that we service, you've already would have received your invite to my next apartment owners educational luncheon. This is an event. We only host it twice a year. You have to get your seat because we fill up every time. We fill up very fast. The date is quickly approaching. And so again, you would have received an invite either via email, via direct mail. That's how you know you're invited because you receive an invite. It is a closed invite because we keep the event small and intimate. We want to give an opportunity to the investors, the landlords that attend to be able to ask questions and interact with the speakers that are presenting. And we have a powerful lineup that we are offering this year. We have everyone from eviction attorney to someone who specializes in property insurance and can help you weigh those waters and all the things that are changing with property insurance. We'll have an individual speaking about tenant buyouts and how to reposition tenants. Someone that will share exit strategies on multifamily. Of course, I'll dig into the analytics you saw today are nothing compared to what I'll share at our educational event. We'll get much more granular and really set forth a path of, okay, well, here's a path to profits, and we're going to dig into that and what investors can look for and look or anticipate as we move in to the next year. So for those of you who are invited, I highly suggest you reserve your seat quickly. Seats are going very fast. We look forward to having you. There's, in my opinion, there's not quite an educational event like this where you get this many professionals in one room, no sales pitch whatsoever. They're literally there just to educate you, the investor. You leave just with a ton of knowledge, and you're able to network with other landlords that are going through the same things you are, and you can bounce ideas off of each other. It's a great afternoon, and we serve a great lunch, so that's just cherry on top there. I hope you found today's video informative and the information that we've shared. I'm really trying to create that content that serves you, the landlord, that's meaningful, that can help you in the ownership management of your multifamily portfolio. We look to lock arms with you as you're building this financial legacy in multifamily properties. And if you feel like today's video helped you do just that, would you please give the video a like, share the video with other investors that you know. That helps us get the content into that many more people's hands. You notice that as you watched my video today, there was no breaks for commercials and that sort of thing. Why? Because all this information is free. I don't look to make any money off our YouTube channel or the videos that we've created. It's all free. And again, just our way of servicing you, the landlords. And until next time, this is Kris German, the apartment dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.